Picture this. It is late 1998. A fund called Long-Term Capital Management is packed with Nobel-level brainpower and decades of bond trading experience. The models say the trades are safe, the spreads should converge, the probability of a disaster looks tiny. Then Russia defaults, correlations snap, liquidity vanishes, and the fund is suddenly facing margin calls that do not care about intelligence. That is fear arriving all at once, not as a feeling, but as a forced liquidation. Now flip the scene. It is 1999 into early 2000. Tech stocks are going up every week. People who never read a balance sheet feel like geniuses. Greed is not just wanting more money. Greed is the belief that risk has been tamed. Greed is the story that this time the old rules do not apply. I want to talk about the psychology behind fear and greed because most investing mistakes are not math mistakes. They are nervous system mistakes. They show up when uncertainty gets loud. In markets, uncertainty means you do not know the outcome, and you cannot know it in advance. Risk is different. Risk is what you can estimate about the range of outcomes. Most people treat risk like a number, like volatility. Volatility is how much prices wiggle around. It is visible, it is easy to measure. The problem is that the worst losses often come from tail risk, which means rare extreme outcomes that sit in the fat tail of the distribution. Those are the moves that do not show up in your recent sample. Fear and greed both distort how we perceive those tails. Greed tends to compress time. When prices rise, the brain starts to treat recent gains as a baseline. That is called recency bias, which means we overweight what just happened and underweight what happened before. In a bull market, recency bias quietly rewrites your risk model. You start to size positions as if the good regime is permanent. A regime is just the market environment, like low inflation and easy liquidity, or high inflation and tight liquidity. Regime shift is when that environment changes faster than your beliefs do. Fear does the opposite. Fear expands the downside in your mind. It makes every unknown feel like catastrophe. That can be useful when it forces you to respect risk of ruin. Risk of ruin is the chance you lose so much you cannot continue. But fear can also make you dump good assets at the worst possible time because your brain wants relief, not expected value. Expected value is the long-run average outcome if you could repeat the same decision many times. Most adults understand it through insurance. You pay a premium because you want to avoid a huge loss, even if the average cost is slightly negative. In investing, you often do the reverse. You accept small frequent gains and ignore the small probability of a huge loss. That is picking up pennies in front of a steamroller. Greed loves that trade because it feels smooth until it does not. LTCM is a clean case study. Their strategies were not crazy in isolation. They were convergence trades, betting that mispriced bonds would move back toward fair value. The killer was leverage and liquidity. Leverage means borrowing to increase position size. It amplifies gains and losses. Liquidity is how easily you can exit without moving the price. In a crisis, liquidity disappears when everyone wants out at the same time. The spread between what you can sell for and what you think it is worth becomes your real risk. That is when fear becomes mechanical. It is not emotion, it is margin. Greed often shows up as a quiet change in standards. You stop asking, what is the downside if I am wrong? You start asking, what if I miss out? That is FOMO, fear of missing out, which is a social emotion. Markets are social systems. Price is not just information. Price is also persuasion. Rising prices recruit more buyers. That feedback loop is reflexivity, which means beliefs move prices and prices reinforce beliefs. George Soros popularized that idea. You do not need to agree with every part of his philosophy to see the pattern. When price goes up, narratives get stronger. When narratives get stronger, more money flows in. Greed is often the fuel for reflexivity. The dot-com era is a classic. Many companies had no earnings, some had no real business model, but they had a story. The story was that the internet changed everything, which was partly true. The mistake was turning a true innovation into a false valuation anchor. Greed makes you confuse a great product with a great investment. The future can be huge, and the stock can still be overpriced. When the crash came, fear did not ask whether the internet was real. Fear asked, who needs cash today? Who is leveraged? Who is forced to sell? I want to bring this down to the level of a normal investor looking at a screen. Fear and greed are not moral failures. They are ancient survival programs. Greed is pursuit. Fear is protection. The trouble is that markets trigger them with abstract signals, like a red number or a green number, and the brain reacts as if it is a physical threat or a physical opportunity. One of the most dangerous moments is after a winning streak. You feel in sync with the market. You start to attribute gains to skill. That is attribution bias, which means you credit success to yourself and blame failure on bad luck. It is subtle, but it changes your behavior. Position sizing creeps up. You take trades you would have rejected a month ago. You stop diversifying. Diversification is holding assets that do not all fail together. The key word is correlation. Correlation is how much two assets tend to move together. In calm times, correlations look low. In crises, correlations often jump toward 1, which means everything falls together. Greed sees the calm correlation. Fear experiences the crisis correlation. A good risk process respects both. This is why I talk so much about drawdowns. A drawdown is the peak to trough decline in your portfolio. Drawdowns are not just numbers. They are psychological stress tests. A 10% drawdown feels annoying. A 30% drawdown starts to change behavior. A 50% drawdown can break a plan. The math is brutal. If you lose 50%, you need a 100% gain to get back to even. Greed ignores that convexity. Convexity is how losses hurt more than gains help, because percentages compound asymmetrically. Paul Tudor Jones is often associated with the 1987 crash, and one enduring lesson from that era is that markets can gap, which means they jump past your stop. Stops are orders to exit if price hits a level, but in fast moves you can get filled far worse. Fear tells you that you can always get out. Greed tells you that you will not need to. Reality is that liquidity sets the terms. Now look at a different kind of case study, Barings Bank and Nick Leeson. This was not a genius model blowing up. This was weak controls, bad incentives, and hidden risk. A rogue trader loss usually has the same bones. Positions are not reconciled. Limits are ignored. Reporting lines are compromised. Small losses are hidden and then doubled down. Greed is not always about profit. Sometimes it is about avoiding shame. The trader becomes trapped in escalation of commitment, which means you keep investing in a losing decision because you already invested so much. Fear plays a role too. Fear of admitting a loss, fear of losing status, fear of being fired. Those fears can create the most irrational risk-taking you will ever see, because the goal shifts from making good bets to surviving the next meeting. That is why risk management is not just about models. It is about governance. Who can say no? What happens when someone is wrong? Are losses treated as information or as moral failure? In healthy systems, you want fast error correction. In unhealthy systems, you get concealment. If you are managing your own money, you are the governance. That is hard because you can lie to yourself. Greed lies with optimism. Fear lies with catastrophizing. The antidote is not to become emotionless. The antidote is to build a process that assumes you will be emotional. Kelly criterion is one way to think about sizing. It is a formula that tells you the optimal fraction to bet to maximize long-run growth based on your edge and odds. In plain language, it says even a good bet can be fatal if you bet too much. Most real-world investors should size below Kelly because estimates are noisy and tail risk exists. Noise means your inputs are uncertain. When your inputs are uncertain, aggressive sizing is a hidden form of leverage. Ray Dalio has talked for years about balancing risk, not just capital. Risk parity is one expression of that idea. It means you allocate so that no single asset dominates your portfolio volatility. You do not need to follow that approach to learn the lesson. The lesson is that what feels safe can be risky if it is crowded, leveraged, or dependent on one regime. Warren Buffett and Charlie Munger are useful here because their public record shows a different relationship with fear and greed. They did not avoid fear. They respected it by avoiding leverage and demanding a margin of safety. Margin of safety means you buy with a cushion, so you can be wrong on some details and still be fine. They also did not chase every boom. That is not because they lacked imagination. It is because they understood opportunity cost and circle of competence. Circle of competence means you know what you understand and you admit what you do not. For a normal adult investor, the hardest part is that markets punish and reward on the wrong schedule. You can do the right thing and lose money for a while. You can do the wrong thing and make money for a while. That is why fear and greed are so persistent. The feedback is noisy. It trains bad habits. So I try to anchor on a few practical truths. First, I assume I will feel greedy after gains and fearful after losses. Second, I treat those feelings as signals to check my sizing, my leverage, and my liquidity. Third, I focus on survival. Survival is not conservative. Survival is what gives you the right to compound. Compounding is the process where gains build on gains over time, and it only works if you avoid the kind of loss that takes you out of the game. The market will always offer a new reason to feel urgency, a new bubble, a new panic, a new narrative.